It's Rocktober. Apparently, markets flying all over the place. What does that mean for you and your money? Well, let's get into it this morning. There's some good, the bad, and the ugly that's going on with the markets right now. I'll start with the good. The good is that markets remain very oversold here and are really pushing very negative money flows, oversold conditions, and volume has been drying up also on this entire process of this consolidation we've had above support here recently over the last few days. So that's the good side. The not so good side of this is that we are continuing in this very volatile downtrend at this point. Markets have been unable to sustain any type of rally here. So again, lots of internal weakness. More than 90% of the stocks in the S&P 500 have now had a 10% correction. That even goes for the big major FANG stocks as well. So we're seeing a lot of internal destruction in the markets. That's certainly worrisome in the short term. The bad news, if you want to call it that, is that we are forming a head and shoulders pattern at this structure of the market. And there's a very clearly defined neckline going all the way back to the June and July tops and bottoms that we said previously. A break of this head and shoulders pattern would suggest a retest of the 200-day moving average, if not a bit lower here, because normally that's the topping process that is put into place. Do I think that that's going to be the case? Not necessarily, but it's certainly worth paying attention to. And if we do break this neckline of this head and shoulders pattern, it certainly does suggest lower prices and a reduction of overall portfolio risk at the same time. The one thing that's been undermining this rally in stocks as of late has been this very sharp rise in interest rates. Now, this rise in interest rates is a function of concerns over the debt ceiling, the potential default on bonds. None of that is going to happen. We will pass the debt ceiling. Interest rates will decline after the debt ceiling is raised. That's historically what happens as money gets repositioned back into safety positions in Treasury bonds. But in the near term, traders are very short Treasuries right now, and that's been leading to this rise in rates. Couple of things here, though, that are going on. First of all, we're still kind of in this topping process for interest rates, suggesting that we're going to see lower rates in the near future. And given the inverse nature of interest rates and yields, we're very close to a buy signal on interest rates currently, suggesting that bond prices will rise and interest rates will fall. So again, very likely we're going to see interest rates come back down here shortly. That should provide some lift for stocks, and this should all occur after we get the debt ceiling passed, which I suspect will happen in the next couple of weeks as we approach that October 18th deadline. The pressure will be on Congress to get that done, and that should lead to the better last half of October and into the November-December seasonally strong period of the year. I'm your host, Lance Roberts, for 3 minutes on markets and money. I hope this helps, and we'll be back tomorrow with, got a report on what happens with the markets today. See you then.